You want an apartment. You find a great one. You apply. Rejected. Not because you're broke. Not because you have a criminal record, because a 3-digit number said no. That number runs more of your life than you probably realize. It decides if you get the apartment, what interest rate you pay on your car, whether your loan application gets approved in 3 seconds or never. Some employers even check it. It's your credit score. And almost nobody understands how it actually works. Here's the thing. It wasn't built for you. It was built for lenders. And once you understand that, the whole system starts making a lot more sense. Before credit scores existed, getting a loan was a vibe check. You walked into a bank. A manager looked at you. He knew your family, your job, your reputation in town. He made a call. Subjective, inconsistent, and, let's be honest, often discriminatory. In the 1950s, 2 guys named Bill Fair and Earl Isaac tried to fix this with math. They built a formula, objective, consistent, scalable. Their company eventually became FICO, Fair Isaac Corporation. By the 1980s and 90s, banks loved it. No more gut feelings, just numbers. Fannie Mae and Freddie Mac, the giants of the mortgage market, started requiring FICO scores for loan decisions. And just like that, your financial life got reduced to 3 digits. Your FICO score runs from 300 to 850. Below 580, bad. 580 to 669, fair. 670 to 739, good. 740 to 799, very good. 800 and above, exceptional. Most people sit somewhere in the middle. The national average in the US hovers around the low to mid 700s, depending on the year. Here's what almost nobody tells you. There isn't just one credit score. FICO alone has dozens of versions. There's FICO 8, FICO 9, FICO 10. There are industry-specific scores for auto loans and credit cards. Then there's Vantage Score, a competing model created by the 3 major credit bureaus. So when someone says, check your credit score, they mean a credit score. Not the credit score. The number changes depending on who's asking and why. FICO is built from 5 factors. Knowing these is the whole game. Payment history, 35%, the biggest one. Do you pay your bills on time? One missed payment, especially if it goes 30 days late, tanks your score fast. Pay on time, every time, non-negotiable, amounts owed, 30%. This is really about credit utilization, how much of your available credit you're using. If your credit card limit is $1,000 and you're carrying a $900 balance, that's 90% utilization. Terrible. Under 30% is the general advice. Under 10% is better. Length of credit history, 15%. How long have your accounts been open? Older is better. This is why closing your oldest credit card, even if you never use it, can actually hurt your score. Credit mix, 10%. Do you have different types of credit? Cards, loans, a mortgage? A mix signals you can handle different kinds of debt. Not the most important factor, but it's there. New credit, 10%. Every time you apply for new credit, the lender does a hard inquiry. That temporarily dips your score. Apply for 5 cards in a month and it looks like you're desperate for cash, which is not a vibe lenders enjoy. Let's use Marco, 26 years old. Has 1 credit card he got at university. Pays it off most months. Never checked his credit score in his life. Marco wants to rent his first real apartment. The landlord pulls his credit. Score, 638. Fair. Why? Card utilization at 65%. Short history. Account is only 2 years old. No other credit products. No mortgage. No personal loan. Nothing. The landlord asks for an extra month's deposit. Marco didn't even know this could happen. That's the credit score operating in the background of your life, quietly making decisions you're not in the room for. Who makes money? Here's where it gets interesting. FICO is a publicly traded company. It charges lenders every time they pull your score. Mortgage lenders, auto dealers, credit card companies, they all pay per inquiry. FICO does billions in revenue from this, but the credit bureaus, Equifax, Experian, and TransUnion, are a separate business. They collect your financial data, every credit card, every loan, every missed payment gets reported to them by lenders. They compile that data and sell access to it. You're the product, or more specifically, your financial history is the product. And here's the dark part, the bureaus make mistakes. Studies have found a significant share of credit reports contain errors, wrong balances, accounts that aren't yours, late payments that were actually on time. These errors can drag your score down for years if you don't catch them. You're entitled to one free report per bureau per year at annualcreditreport.com in the US. Most people never look. Marco, by the way, had an old gym membership reported as a collection account. He'd canceled it 2 years ago. Jim said he owed a final month. He never paid, never even knew it was sent to collections. That one item dropped his score by a meaningful amount. One gym membership. From a gym he stopped going to. The system has a fundamental design flaw. To build credit, you need credit. But to get credit, you need credit history. Classic catch-22. Young people, recent immigrants, and anyone who's been operating on cash their whole life get penalized by a score that simply has nothing to work with. Called a thin file. Not bad credit, invisible credit. And invisible credit gets treated almost as badly as bad credit. The solutions are limited. Secured credit cards, where you deposit money as collateral and get a card up to that limit. Credit builder loans. Being added as an authorized user on someone else's account. None of these are fast. The system is slow by design. Building a solid score from scratch takes years. Once you understand the 5 factors, you can work with them. Pay on time, always. Set up autopay for at least the minimum, not because minimums are good, but because a missed payment is catastrophic. Keep utilization low. If you can't spend less, ask for a credit limit increase. Same balance, higher limit, lower utilization percentage. Works mechanically. Don't close old accounts, even if you don't use them. Length of history matters. A card sitting in a drawer is still helping you. Don't apply for a bunch of credit at once. Space out applications. Each hard inquiry is a small ding. Multiple hard inquiries in a short window look bad. Check your report. Find errors, dispute them. The bureaus are legally required to investigate disputes. It takes time and follow-up, but errors can be removed. Marco disputed the gym collection. Took 3 months, got it removed, score jumped. He reapplied for the apartment. Different building, but still. Here's the uncomfortable reality. The credit score system rewards people who are already participating in the financial system. People who have credit cards, who took out loans, who have a history of borrowing and repaying. People who saved cash, avoided debt on principal, or just didn't engage with credit. They're invisible or penalized. It also creates perverse incentives. Closing a paid-off loan can hurt your score. Having no debt can look worse than having managed debt. The system is optimized to measure credit behavior, not financial health. A person with $50,000 in savings and 0 debt could have a worse score than someone with $8,000 in credit card debt they're slowly paying off. Because the second person is using credit, and that's what the score actually measures. Quick recap credit score runs 300 to 850. Higher is better. Built by FICO in the mid-1900s. Designed for lenders, not you. 5 factors: payment history, utilization, length of history, credit mix, new credit. Multiple scores exist. The number changes depending on who's checking. 3 bureaus collect the data: Equifax, Experian, TransUnion. Check your reports for errors. Thin file problem is real. If you're young or new to credit, you're at a disadvantage. You can game it. Pay on time. Keep utilization low. Don't close old accounts. Don't mass apply for credit. The system rewards credit behavior, not financial health. Know the difference. Your credit score is not a measure of how good you are with money. It's a measure of how good you are at using debt in a way that makes lenders comfortable. Those are 2 very different things. And once you know that, you can stop trying to impress the number and start using it as a tool. Marco's score is now 714. Same guy, same income. Just removed an error and lowered his utilization. 3 digits. Totally gameable. Once you know the rules. If this video saved you from a bad credit decision, hit subscribe. Your future landlord will never know, but you will.